Sales training. Brilliant. So now this chapter will be focusing on everything we're going to need to be on the phone, speaking to prospective clients, and in turn bringing on board their assets. We will be discussing the different stages from first call, second call, third call, understanding what is a good lead, and then also the objections and how to handle the objections, because when it comes with sales, you are naturally going to get individuals which are not interested. Okay, and that's absolutely fine. No matter what pitch you have, or no matter how good you feel you are on the phone, there will be investors that are just not interested, and that's absolutely fine. It's just not right for them. Sales, especially financial sales, it is a numbers game. But it's important to make sure every phone call that you are having is, put together well and structured well, which is the most important part. And we will be going through all elements. As mentioned, there's no magic formula, so let's get straight into it. Okay, now we're just going to be focusing very much on the first call process and what really is classed as a qualified lead. Now, let me just break it down. As you know, I come from a derivative broking background. I've been here. I've dealt with, over a year and a half, 2 years, purely focusing on sales, bringing on board assets, opening up accounts for seniors to naturally trade and advise on. So I know the whole process, and I know what it takes to get to that level. That's not suggesting that I was, the best of the best, but we did fairly well in the process. And a lot of it is not about the gift of the gab. A lot of it is not about having a set structure or a set sales pitch that you follow word for word and automatically accounts will open. It doesn't work like that. Any form of sales is about what you know. Okay, and I'm hoping that all the information that you have digested will be your arsenal needed in order to help educate investors in order to bring on board their assets. Investors are not going to be opening an account and speaking to someone that has less knowledge than them. That's the brutal fact about it. Imagine yourself, if you are looking for life advice, you usually look for life advice from someone who's seasoned, been there, done that, and worn the t-shirt. So you want to be in a position where you portray yourself as a educator. You are qualified to understand what's happening in the financial markets, and you are qualified in understanding how you can provide a solution. That is the aim of the game. So when we talk about what it'll take, or what an average day as a broker is, it's very simple. You're there to speak to active investors and bring on board their assets, open accounts. Okay, they're naturally going to have brokers elsewhere, which is fine. Okay, you got to put yourself in a position where you can be the asset that they require. Now, we naturally stage it in multiple calls. It's never a first, second, and third call. It's always going to be multiple calls. Okay, but I've just structured it in a way where you get a gist of what's expected. So even though we will go through the 3-call process, it never really is that way. All right. So when we discuss the first call process, this is our first interaction with an investor or with a prospect. Okay, your aim really is to introduce yourself, as well as who you represent, what company are you part of. The end goal will be to get out some form of key information, some form of literature, okay, in order for them to read up upon the company and get a better understanding of what you do. Okay, but a lot of the traditional brokers, junior brokers we've seen, or sales brokers we've seen in our time, they will focus very much on just getting out a brochure and believe that's what you class as a lead. Okay, it's like saying, look, hi, my name is Arjun, I'm calling from the Institute of Broking. I understand you requested information from us in the past. That can be accurate or not, okay, but sometimes they will use that, and they'll say, look, your email address is XYZ. I just want to get some further information over to you. Okay, more than likely the individual on the end of the phone is going to be like, yes, that's absolutely fine, send me the brochure. Okay, and then the phone goes down. The problem with that is all you've done is confirm an email address. Okay, by confirming an email address, we've not gauged whether this individual is active. Is he looking to get involved? Where is his portfolio? How is he finding the market? Okay, so these are the issues that traditional sales brokers will have. They're not just acquiring enough information. I would personally go about it in a different way. I would say, look, hi, it's Arjun calling from Institute of Broking. Hope all is well. We understand you may have requested some information from us in the past. We're just keen on getting some updated reports to you, just with regards to a number of our strategies or how well we've done in the last 12 months. I believe your email address is still XYZ, and they will say yes. Okay, a traditional broker will put down the phone, but you should go that extra mile and say, look, just out of interest, how are the markets treating you? Are you still active in the market? How have you found the market over the last 12 months? What's worked well for you? Okay, these are the sort of questions you want to get out, because that's going to make your second call a lot more detailed and informative. You're there to try building some form of rapport, okay, where this individual will remember you. Okay, he'll say, okay, or she will say, okay, I remember speaking to you last week. Yeah, I found your information helpful. So there will be objections at times. Okay, a lot of it will be based around they're just clearly not interested, and we will come on to that with our objection handling stage. So, in a nutshell, the first call is very much to introduce yourself, the company, explain to them the reason for the call, get some information out to them, but then keep pursuing it. Really ask them, how well they're doing, are they still active, how have they found the markets, where do they see the markets going in the next 6 to 12 months, are you getting any advice, are you doing it yourself? All these sort of questions are things that you can ask. And look, don't get me wrong, you're not going to be in a position where you will ask all the questions. This is an ideal scenario that I'm explaining. More often than not, you've got less than 60 seconds on the phone, so sometimes it's not, you're not in a position to ask these many questions. Okay, so I always suggest have a lot of these questions written down, so you are in a position to, ask them if they do come up. But yeah, in a nutshell, that is going to be your first call process. Now, when we talk about qualifying a lead, okay, this is an important part. As mentioned, we just don't want to find out an individual's email address. That's not how it works with a lot of the firms you'll go to, or even if you're doing your sales by yourself. It's important to take on board a lot of this information. A qualified lead, in our opinion, is someone who has been identified as having the right sort of financial profile or interest, or someone that intends to engage with us moving forward. Okay, that is naturally classed as a qualified lead, someone that would ideally say, yes, I'll be more than happy to hear back from you. Oh yes, I am open, I am in the market looking for X, Y, and Z. Okay, it's not always going to be easy as that, of course, but that is ideally the sort of qualified lead we will look for. So here are a few bullet points that are you should always keep in front of you and make note of. First, confirming personal details of the prospect. That could be email, it could be the number, it could be that's pretty much it for that. When it's financial capability, is the individual invested? Do they have capital, or are they someone that's retired? May not have a huge amount of capital. You've got to be realistic. There's certain investment firms that will have thresholds on how much they require to be on account. Some firms will have, you can only open an account if you put 100 grand down, for example. That can be assets and cash. So if you know for a fact an individual really doesn't have a huge amount of capital, or they're an incredibly small investor, that might not be a lead worth pursuing. Okay, it just wouldn't be worth your time. So really understand their financial capability. What are their investment goals and interests? Okay, does this individual, have a goal where they're looking for income-based portfolios? Are they looking to take advantage of, market rallies? What are their goals? What are their interests? Okay, and are they open to potentially hearing further information? I'll be brutally honest, more often than not, they're going to be like, no, I'm already catered for. I've already got a broker, XYZ. We can always overcome that. And you've got to be in a position where you can differentiate yourself from other brokers or whoever they're currently with. Understand their risk tolerance. I think this is an important one as well, as you want to be in a position where you can understand your prospect better. Are they looking for purely, a purely passive approach to investing where they are looking just to buy stock and leave it there? They're not looking to rejig their portfolio. They're focusing very much on low beta, or do they have a more aggressive approach to investing? Are they in a position where they like CFDs, leveraged ETFs? Are they looking to take advantage of high beta areas? These are elements you want to be aware of, as it will help you in your next call to structure your advice, not necessarily advice, structure your proposals better. Okay, that is going to be one of the key elements. And as mentioned earlier, are they open to new advice or opportunities? Okay, you will naturally get some kickback in this sort of area, but if you can go through all these bullet points and get as much information out of an individual that can mimic each of these bullet points, then that would be classed as a qualified lead. That would be worth your time. That's worth the company's effort in order to call back, as you've got enough information to build a strategy, to build an actual pitch. If we don't have all that information, I'll be brutally honest, it would not be classed as a qualified lead. Okay, so always bear in mind what you're looking to achieve, and if you follow these bullet points, the first call would be used to its best ability. Okay, if we had a productive first call and we had a quality lead generated, then our second call should be a lot more straightforward. Not to say it's going to be any easier, as what you will expect on a second call is you starting to delve deeper into the prospect and the investor, asking more meaningful questions. And with that being said, you are more than likely to come across a lot more objections. Okay, and when we mention the second call, it's not just a one call. This could be spread across multiple weeks. Okay, every week finding more and more information, whilst the investor decides whether they want to come on board or not. So it's never, as I mentioned in the previous slide, a very simple, 3-call process. But in our second call, what will be expected of you is to delve deeper, ask more meaningful questions, address any objections they are going to be having. The need to build a trust and rapport is going to be essential, as we will ideally want to get some form of soft commitment or pre-commitment, where an investor is in a position to say, look, I'm happy to come into the office, or I'm happy to discuss further, or be in a position where they say, look, we've got 10,000, 20,000, 100,000 liquid and are prepared to potentially do something with that. Now, the key questions to ask in this call are going to be very important. Okay, the first, and I don't think a lot of people spend a lot of time in this, is did you read the brochure or the information that we sent? Because a lot of the information that will be sent over, at times investors don't read, at times they do. It's important that you show an interest in the information you've put forward. It could be maybe an investment report on certain stocks. You may want to go back to them and say, look, I'm not sure if you read the report that we sent over last week. It was in regards to Barclays, for example, and this week Barclays had a great set of results. They're up over 2-3%. That's the level of research that we offer. Those are the sort of questions you want to be asking early on, as soon as you pick that phone up. And now we'll be going into a lot more detail on what the company does, and how they go about dealing with investors in a similar situation, whether they're focusing on retirement, income, and so forth. You want to be highlighting stories which have done well, ways in which the company has used its strategies and its research to take advantage of a falling market or a recovering market. You want to be in a position on building trust as well as building potential portfolios. Understand your client more, clarify their investment needs. Ask questions like, what are you looking to achieve in this market? What market condition are you waiting for? If they're uncertain. You want to get a better understanding of if they're looking for income growth speculation. Are they more high risk tolerant? Are they more low risk tolerant? Okay, so these are the areas which we want to delve into. Okay, as well as understanding their financial situation. We would have touched upon it maybe in the first call, but it may also be the case you're just asking right now. Ask the client, look, what is the size of your portfolio? How much do you tend to invest per stock? Okay, what is your allocation towards income and purely dividend based stocks? Okay, if you are to invest in a strategy we put forward, what sort of liquid capital do you have available? Now, these are very intrusive questions, don't get me wrong. Okay, but you've got to be in a position where you are asking. They will naturally come back and say it's none of your business, but you should fire back and say, look, we're just here to build a slightly better picture on what sort of investor you are, so that any sort of strategy or solution we put to the table is actually catered towards your investment needs, as we focus very much on providing a bespoke service to all clients, because not one client is the same as others. Okay, identify any concerns or objections. A lot of investors may always say they're not going to they will not be looking to invest. Okay, that's their usual response. I'm not investing at the moment. You want to understand why. What is the reason you are not looking to invest? What market condition do you need to see in order for you to get back involved in the market? Okay, so treat the second call more of your real fact-find information. And when I talk about the pre-commitment, it is the case at the end of the call you want to have something to latch on to in order to have another call. Look, so if we are in a position where we can put together a strategy that makes clear financial sense, how receptive are you to taking on board that advice? How receptive are you to giving us the opportunity to contribute towards your success of your current portfolio? This is what you want to do. If they say, yes, look, I'm open, they'll say, no, I'm not in a position to want to do anything. So you still want to try being as persuasive as possible. But, as I said in the earlier slide, if someone's genuinely really not interested, there's no point trying to force it. What I tend to do is, if individuals are not interested, no matter how hard I've tried, I always do courtesy calls, every other week. Just purely picking up the phone, making a client aware. He or she looks, ma'am, I've had a look at the financial markets. We've just had data out. Markets are reacting this way. These sort of stocks are doing well. Or it could be earnings season. These companies have reported this sector is doing well. It's just more of an informative call just to keep me in their mind. There may be a situation down the line where they will look for advice, or they may look for a new alternative. And by you being the individual that calls them every other week, they'll be happy. So don't be disheartened if they are not looking to open an account or provide any form of commitment at this stage. Absolutely fine. Always look to keep in touch. Always look to send information out, and be in the reserves almost. Okay, as there will come an opportunity down the line perhaps where they will look to get on board. Okay, so in a nutshell, that is how your second call will look, and we will then now start to dive into the certain questions you will look to ask. Okay, now what I've done here is just list a number of questions that you should always have in front of you, in front of your desk, that you should be asking prospective clients, especially on the second call. But by all means, try asking in the first call if you are in a position to. Okay. Look, what is your investment objective? What are you looking to achieve? That is one of the most crucial questions that you want to be asking your investor. Okay, because this will lead on to multiple different questions. So when you do ask, what is your investment objective? They may say, my objective is to take advantage of the market, this rallying market. It's very bullish. Interest rates are going to keep going down. Markets are going to keep flying. Absolutely fine. Then your follow-up question should be, just out of interest, what stocks or CFDs do you have in your portfolio that will take advantage of this strategy? Okay. And he or she may come back and say, look, I've got maybe United Utilities, National Grid, and maybe Glaxo. These are predominantly low beta stocks. They have a tendency to mimic the market, not outperform the market. Okay, so automatically by asking that question, you can see that his or her portfolio is not aligned with their objective. Okay, these stocks, yes, they will do well if the market collapses. Low beta stocks have a history of doing so. Okay, they sometimes outperform the market on the upside when the market's crashing. So you want to be in a position where you go back and say, look, sir, brilliant. Look, no harm in believing that this market will rally. A number of the conditions that you mentioned, lowering interest rates, potentially stabilizing economies, will allow investment appetite to still very much be there. But in order to really take advantage of that, history has shown you would want to be looking at more slightly higher beta stocks, sectors such as banking, mining, okay, any form of financials. They are high beta. They tend to outperform the market on the upside, but also outperform them on the downside. But if your objective is to take advantage of this market, you want to be more closely aligned with those sectors. Make them aware. The stocks that you have in your current portfolio, are great sectors. They tend to be great dividend payers, but we have seen time and time again in a rallying market, they don't do as well as high beta stocks. Now, it's important to really look and understand the wording that I use, because whenever we are talking to an investor or a prospect, we cannot guarantee something will happen. I cannot definitively say this stock will go up or it will go down, or this will happen and this will not happen. You have to stay away from anything resembling advice. Remember, you won't be qualified. So if an investor goes and they act upon your information, they could potentially come back to the company and say, look, listen, your broker told me to buy Barclays and it's gone down. I've lost money. Okay, so it's important to understand the compliance element and understand, what you're allowed to say. Words like potentially, history has shown, have you considered, what would you do if this was to happen? They are leading questions, but you're not telling them what to do. If I said, Barclays, or high beta stocks potentially will outperform the market, well, history has shown us that. Okay, after any sort of pullback, any sort of rally, these are the sectors that tend to do very well. So we're using history and information already in our palm to make these assessments. Okay, so going back to the question, what is your investment objective? Ask that. Try getting some information. They may believe, they're just focusing on retirement. Absolutely fine. What stocks do you currently have in your portfolio? They may come back and say they've got Anglo American, they've got Glencore, or they've got HSBC. Okay, these are very high beta sectors, mining and banking. And yes, some do deliver dividends, but not the sort of dividends that you may need in order to benefit from retirement planning. They may want to start looking at more lower beta companies, which these companies tend to reinvest a lot of their profits to their shareholders, or redistribute their profits to their shareholders. So that's one thing you want to be aware of. Be fully in tune with what sort of stocks pay the best sort of dividends, which ones do not. Does the client's stocks or the prospect's stocks align with their strategy? If not, explain it to them. So, as much as the stocks you have probably performed well in this rallying market, they don't have a history or a track record of being top dividend payers. If you are focusing on retirement planning and you are looking predominantly for income and dividends, you may want to consider looking at stocks such as XYZ, as year after year they have produced top 10 dividends or top 5 dividends within the FTSE 100. Okay, make them aware, sir, ma'am, this is the sort of information and research we go through in order to put ideas and understand our clients better. Okay, they would appreciate that a lot more than just reading off a script and say, what is your objective? Oh, you like growth, brilliant, next question. Really start delving and breaking down questions and breaking down strategies to your clients or prospect. The next bullet point we're going to look at is what investment products have they used or got experience in. Okay, now this one is important. First and foremost, it does give you an understanding of the level of experience an investor has, especially if they've got equity then delved within derivative. That's important. Okay, it may help you not having to explain certain elements or functions of certain products. Okay, but the reason why you want to ask what investment products have they used or got experience in, one, obviously to understand their level of experience, and second, really to understand how well they've performed in each of those areas. So when we talk to a client and we ask, what experience he's got equities and CFDs, your follow-up will be, oh, how well have you done in each of the areas? What area has provided you with the most return or the more stable return? How well did you do with CFDs? Who did you do CFDs with? Do you do equities and derivatives with the same firm? Okay. What sort of ratio do you have? Is your portfolio predominantly equity based? Are you more medium risk investor, or is your portfolio more derivative, CFD and option weighted? Okay, but then they may say that they've never done ETFs, and that should be your in, because if they are currently with another broker and they're already doing CFDs and equities and they are not looking to move, you got to see which way you can add yourself to that equation. And explaining exchange traded funds. So I'm not sure if you're aware or had much experience in exchange traded funds. It's a very common method for investors to invest in already diversified portfolios. That can take an active front, that can be a passively led portfolio. It allows investors to gain exposure into areas they usually wouldn't have exposure to. And that could be within currency markets, that could be within emerging markets, that could be in commodities. Okay, so use this question to your advantage. When you understand their products, what sort of ratio do they have? What percent is in equities? What percent is in derivatives, for example? What level of experience do they have? How have they been trading CFD longer than equities? That's what you want to be focused on. What areas have they done well in? Have they done better in equities than CFDs? If they haven't done well in CFDs, why haven't they done well in CFDs? Okay, a lot of that could be based around the fact that they haven't had enough risk management tools in place. Okay, make them aware. Look, sir, ma'am, whenever we look to bring any form of a derivative such as CFDs to the table, we focus very much on risk management. CFDs is always seen as a fraction of any investor's portfolio. CFDs are predominantly used to take advantage of fluctuating markets. It's used to leverage. We only expose our clients to anywhere between 4 to 8 CFD trades at any one time. We keep a very active eye on margin. Okay, each position has a stop as well as a limit order. You want to make the client feel safe. You want to make the client feel in a position where you know what you're doing, rather than some brokers will just say, look, we're going long of Barclays as a CFD, even though margin may be at 55-60%, which is considerably high, without stops or limits. So it's more of a punt rather than an educated guess or educated trade. So really start dissecting that, and ways in which you can inject yourself very much in the equation. The next bullet point is, are you looking for growth, speculation, diversification, or a mix? Okay. Um, they may already have a mix, so it's important to understand, as I mentioned in the previous bullet point, what sort of ratios are there. This will give you the risk tolerance of an investor, which is important. Because if an investor is purely focusing on equities, the last thing you want to be doing is, focusing on CFDs and really bombarding that down their throats. But if they are focusing just on equities, you also got to highlight that CFDs could be of value to them. Put scenarios in place. Like, say you've got a very strong equity portfolio, but you and I are fully well aware this market can also go down. How would you protect your portfolio if the market were to have a pullback? Okay, he or she will probably say nothing. Okay, but make them aware. Look, so we do use CFDs not only for taking advantage of short-term movements in the market, but we also use it as a hedging tool, a way in which to protect your overall portfolio in case the market is to collapse. Okay, it's a risk management tool, and it's something that could be advantageous to any investor which is purely focusing on income and long-term equities. But also highlight the fact that if they are with a broker and they are predominantly focused on derivatives and CFDs and options, that would send alarm bells. No matter what your age is, there should be a balance of risk. If an investor is heavily focused on speculation, you may want to question the broker's intent. I would always be honest with my clients. Say, look, sir, you ideally need a balanced approach when it comes to investing. If you are overly leveraged, there is that possibility that if the market goes against you in any shape or form, your capital will be depleted. So you really understand if it's right for their age group and wherever they are. Is income dividends a focus for you? This is a very important. A lot of investors should have some degree of income-based portfolios. But by asking this question to them, if it is a focus, as we say, as I mentioned in my other bullet point, what stocks do you have to take advantage of that? And if they don't have good income-based stocks, highlight the areas where they should be looking. Okay, and always try clothing. Look, so I'm more than happy to discuss this further. If you would like to, visit us in our offices, have a coffee. I'll more than happy to explain our investment strategies, ways in which you can balance your portfolio better, ways in which you can take advantage of, solid income, dividend-paying stocks. Okay. Who currently manages your investment portfolio? There's a strong chance whoever you're going to be speaking to, they will be having advice already. But as years have gone on, it's slightly different to our years when we were managing investment portfolios. There wasn't a huge social media presence. There wasn't a huge amount of outlets that provided information. Now they're everywhere. Everyone's a trader, everyone's a millionaire, everyone is doing the best. Okay, so it's very hard to wind through all that noise. So investors do try doing a lot of it themselves, but a lot of the big ones we notice are still having their portfolios actively managed. Now, when they are managed by someone else, that's absolutely fine. Always highlight, ma'am, majority of my clients have more than one broker. It's unusual for any individual just to stick with one partner due to the fact that there are multiple strategies out there and good providers out there. Your aim when you're asking this question is not to say, oh, your broker's bad, we are better, we are the best. That's what 99% of the people are going to say. and it's probably the wrong way of going about it. You want to see how you can add value. I always go in and say, look, say, you know, obviously our clients have more than one broker. If we are in a position where we could add value to what you currently have, are you open to taking on board another service? How likely are you to take on board another broker in light of the fact, they specialize in something completely different to us? Okay, you always want to be throwing out those sort of questions, seeing what sort of feedback you get. Um, but yeah, on the slide, try looking and seeing who they're with, what sort of service they get, understand the fees, understand the rates. You can always go in and ask, what sort of fees do they charge? But unless they're a massive client, you are not going to, win a client just off fees. Okay, but it's important to know, it's important to understand, oh, excellent, it's being managed by Hargreaves, for example. Hargreaves, let's say they're an advisory. How well are they performing for you? What sort of return did you see over the last 12 months? What areas of advice do they specialize in? What sort of rates are you getting with them? Okay, so that question will always branch off into a multitude of others. Okay, and then once you obtain all that information, that will help you decide, look, okay, brilliant, that they seem to be a very solid equity provider. What we do over here at Institute of Broking is, of course, our bread and butter tends to be building solid equity income-based portfolios for our investors. But we do use the likes of CFDs to take advantage of short-term fluctuations in the market. We use it as a hedging tool just in case the market is to go against us. We focus very heavily on risk management, keeping an eye on margin, keeping stop losses not necessarily tight, but actively monitored. And unlike a lot of providers out there, I don't say unlike your provider, I say unlike other providers, because remember, we're not trying to compete, but let's just keep it generic. Unlike other providers out there, we do have an emphasis on exchange traded funds. We've seen the benefit of having or having some degree of involvement for our clients within actively or passively managed funds. Okay, it allows our clients to get further exposure into areas that they wouldn't naturally focus on: currencies, commodities, small cap stocks. These are already diversified portfolios, remember. So finding out all the information where they currently are is important, and just then adding the value of how well we could work alongside you. We're not looking to change what you're doing. We're not looking to replace what you're doing. We're in a position where we're looking to add value to what you are doing. Okay, so that should be one of your key focuses when it comes to explaining this bullet point to clients. Okay, when it comes to asking the question of what is the value of your investment portfolio, look, that is a very blunt question. Okay, sometimes I've had it, they say, look, it's none of your business. Okay, and that leads to my next bullet point. Another way around it is to say, how much do you invest per stock, for example? What's the average amount you invest? They'll say 10 grand on average they invest. Is that spread across 10, 20, 30 stocks? And he'll be like, it's spread across 20 stocks. So you'll get a rough understanding that his portfolio may be in the region of 200 grand for equities. Okay, that's one way of going about it. But then you ask yourself, look, why is it important for us to know what sort of value the investment portfolio is? Well, the simple answer is we need to know what sort of investor we're dealing with. Is he a big time investor? Is he more a small time investor? And then that will help you understand what sort of strategies and portfolios you're going to be investing. If an investor is, let's say, a large investor and it's got hundreds of thousands into the millions, you obviously need to know where the portfolio is, who is it managed by, what is that split into? Is that equities? Is that property? Is that CFDs and so forth? Okay, but understanding their value will then allow you to go back and say, look, what sort of capital do you have liquid? Because it's very easy when you're opening accounts, investors will be like, what's your minimum? Some accounts have a minimum 10 grand deposit. So if you're dealing with a big investor and you haven't asked how big their portfolio is, you'll just be in a position to say, yes, it's £10,000 to open the account, when in fact the client is liquid for over £100,000. Okay, so then you've undersold the service you can provide them. Okay, so you always want to be in a position to really understand their financial situation, and in turn, when you are presenting a strategy, being realistic. So, with the size of your current portfolio, we suggest that you dedicate in the region of £100,000-200,000 to this sort of strategy. Okay, rather than saying, oh, you can invest £10,000. It's the wrong way of going about it. And I did touch on how much do you tend to invest per position. Again, it's just a little bit of information to understand the size of investor, okay, which helps you present the right sort of idea. Look, if you were to take on board our strategy, how much would you look to dedicate? Liquidity is important. You don't want to be in a position where you are underselling your service, as I mentioned earlier. Because you'd rather be in a position where you focus on very big accounts rather than small accounts. There'll be some investors out there which are only prepared to invest £5,000 or £10,000, and I'll be brutally honest with you, it's probably not going to be. It won't be worth your time, won't be worth your effort. If you deal with a lot of smaller investors, they are more than likely to be discouraged when they see a few losses. Okay, it's natural with experience. We've seen it over time. If people are new to investing and they want to invest £10,000, and then automatically that 10,000 may go down to 9,000, they will be like, hands up, look, I'm not looking to invest any further. So smaller investors are less likely, and they require a lot more attention, really breaking everything down further and further. So again, whichever company you may work for, they will be happy maybe with those sort of sums. But for you personally, you want to deal with the investors which have larger sums. The accounts take far longer to get on board, but they are worth it in the long haul. You rather have 10 really ultra high net worth individuals than 50 small accounts. Let's just put it that way. But yeah, these are the sort of questions to ask to prospective clients. Always branch off into, remember, these are just a set of questions, but they have follow-on questions outside of that. You are asking the questions to build enough information in order to sell. Okay, it's not just a tick box. So he's got 100,000, he invests 5,000 in stocks, he's looking for income and growth. Okay, you need to break that down further. So as I mentioned, what is their investment objective? Have they met their investment objective? Okay, if not, why not? There must be a reason behind it. Are the stocks in their portfolio not aligning with their strategy? Help them out with that. Provide them a solution. What investment products have they got experience in? What ratio? Are they more equity, CFD, options, ETFs? Break that down. Understand their ratios. Are they looking for growth, speculation, diversification? Okay, that will tell you their mindset. And that can change moving forward. They can be income and growth now, but then with the market rallying, they may want to shift capital and start, dedicating extra funds to CFDs or derivatives. Okay, understand their dividends, understand the size of their portfolio, and in essence, that will be the most important questions you would have to ask. One final point that I want to make, I don't want to talk too long on this topic, but the final one I want to discuss is you have to have the ability to build rapport. If you sound like you're just reeling off questions, you are not building the trust of that individual. A lot of the best people in my industry and the previous company I worked for, they were very, very good rapport builders. Really great at their job, but they were really good at rapport. Clients could sometimes be offside and still invest money into their account because they had a good rapport with their broker, and that counts for a hell of a lot. So do take an interest in, what they do for a living, what they do in their spare time, what they do on the weekend. Don't just ask it for the sake of it. Really try understanding and working with an investor, because it's going to be a long relationship and ideally fruitful for both parties. So do take your time breaking down the individual as well. What do they do? Are they married? Are they retired? Do they have kids? And of course, it should never be a tick box scheme. But if you are a good conversator and you can communicate well, a lot of these questions will come naturally. Okay. Okay, now we're just going to cover the closing call. Ideally, this has to be the call where you are guiding the prospect towards making a final decision. Ideally, that will be opening an account and funding the account. It could also be having a firm commitment for the client or prospective client to come into the office and discuss further the strategy and ideally open the account. So this is the end point. And to get to the closing call stage, a lot of the information you would have already acquired from the first, second call already. Sometimes, obviously, more. There's never, as I mentioned, there's never a 3-call process. It is always a multiple call process. Now, what we're expecting on this call is very simple. One is to recap key points and benefits of opening an account. You really want to reinforce the value that you and the company can offer. Remind the client of the strategy and the proposals you have in mind and how that really aligns with their current needs and their objectives moving forward. Okay, as mentioned, a lot of this information you would have acquired from the first 2 conversations. It could have been, sir, look, it's very clear that you are looking for a portfolio that's going to take advantage of a rallying market, as well as addressing some income and dividend needs. Okay, and then you would have put forward a strategy where you would look to dedicate the bulk of a client's portfolio towards solid income based stocks, low beta stocks, high dividend paying stocks, with very strong dividend covers, as well as dedicating a fraction of capital towards the likes of CFDs, where you can take advantage of the short-term shift in the market, take advantage of a negative market if that is to occur, or to hedge. Always aligning the fact that you focus very heavily on risk management, keeping an eye on margin, understanding the auction periods where you may want to adjust stops and limit orders. You've got to provide that element of security and safety to the prospect for them to really want to say, what, yes, he understands exactly what I'm looking to achieve with my portfolio, and he has put together a constructive strategy. Ideally, we would want the phone call to be as smooth as, recapping strategies and opening an account, but there is always going to be some form of objection. It could be timing, it could be capital. So these elements are still going to be very, prevalent, but we will obviously discuss that in our objections slides. But when it comes to handling final objections, it's important to go about it in a way where you're not highlighting any objections. You just want to ask them, look, is there any other questions or queries you have in regards to the strategy that we have put forward, or our outlook on your overall portfolio? You don't want to be using words like objection or concerns. You want to stay away from those sort of buzzwords. You don't want to go in there and say, do you have any further objections I can address? That's not the way to go about it. It would be a case of, do you have any other questions? Is there anything you would like me to explain in a little bit more detail? Are you comfortable with the overall strategy and the outlook? So always be forthcoming with that. Don't wait for them to have to fire back any objections. Always ask them, look, sir, ma'am, was there any questions or queries that you had? I've put sense of urgency, when you are making a final call. You don't want to drag the process out too long, but of course I do appreciate not everyone's going to be in a position to act straight away or want to open an account straight away. So yes, you have to adjust to the needs and the time frames of the prospect, but always try putting some time frame in mind, especially when you are discussing opening accounts and strategies. Always reflect on the current market condition. If we are experiencing a rally within the market, you want to be in a position where the strategy would work well in this current condition. Or if the market is set to have a pullback, make it clear, look, the signs are there that the market could have some form of a correction or a pullback. If we are to open the account, have it funded, we can react straight away if we are looking to buy any form of dip or take advantage of a falling market by using the likes of CFDs. Always have it time sensitive. It could be based on the time of the year. Coming towards the back end of year, heading into Christmas, we naturally tend to see a rally within the market, and a lot of that is led by the big investment banks trying to hit targets. So we do see a lot of activity and rallies in the market. So it tends to be a good time. Okay, no guarantee, but it tends to be a good time for investors to see an uptick in their overall portfolio. So, make it very time sensitive, Luke, even if it's a meeting. So what's your plans like for, end of the week, next week? How does 12 o'clock sound to you? So always have some form of time frame or point that you feel it'll be great either to meet a client or for the client to open the account. With the next point of presenting a clear action plan, it's very much in line with the first bullet point there. You are recapping what the company does, its benefits, recapping what the client is looking for. But when it comes to presenting a clear action plan, this is in essence what a client's going to buy into. Okay, is it the fact that you are going to build an income and growth based portfolio, focusing predominantly on solid equities, fraction within CFDs, and an element within ETFs? Is that the action plan? Because we could very easily, and we've taught a lot of our staff very simply, so ma'am, we focus on building a solid income and growth based portfolio. We target top dividend paying companies with solid dividend covers, and we do dedicate an element of your capital towards the likes of CFDs to take advantage of short-term fluctuations in the market, again reinforcing the risk element or the risk management element. And then finally, guide them towards ETFs. Look, a lot of providers out there are not focusing heavily on exchange traded funds. It doesn't seem to be a bulk part of a lot of portfolios, in light of the fact that it can give you exposure into areas and markets you've not got much knowledge or experience in. Okay, so always set out a clear action plan with your client for them to visualize what they're getting themselves into. The final part would be just really clarifying the next steps. Any form of paperwork, any payment details. It's important for the client to be aware if they are to come on board. These are the stages that they would have to go. They would have to present forms of ID. They would have to, do, for example, retail client profile or a KYC, just so that we can make sure that whatever strategy and solution we are putting forward on the table, they are in a position where they are comfortable with it and they understand the risks associated with it. And the final point is, provide reassurance and build trust. Make the client feel secure in their decision, and the aim is to build long-term trust. And trust doesn't come overnight. It's about building upon your rapport, making yourself accessible to your client, making your client aware that you are looking out for their best interest rather than just being another account on the board. So these are the tips that I suggest you focus on your closing call, and it will make life a hell of a lot easier. Okay, now so in this slide we're just going to discuss certain things that make individuals successful within sales. As we always say, there's no, magic potion formula. But these are elements that if you're trying to get into the industry or you want to continue adapting and getting better, these are the elements you want to be really focusing on and enhancing as much as you possibly can. Now, the one at the top is obvious. It is communicational skills. I think that's in anything in life, especially if you're on the phone or you're trying to bring on board clients, convince someone to do something that they may not want to do. You've got to have solid communicational skills, and a lot of that is not what always comes out of your mouth, but also being an effective listener, understanding an individual's needs, areas which are not going so well. So being an active listener will allow you to pick up on verbal clues on where an investor is, and where you can add value. When it comes to sales, they always say the other party should be doing most of the talking. You should always be having open-ended questions. You should be there just listening, taking note, and adjusting your pitch and tone in relation to how someone is speaking to yourself as well. It does allow you to be a lot more persuasive and building upon negotiation skills. Okay, you're there to really influence a customer's decision by clearly explaining the benefits and tailoring any form of strategy and solution towards their needs. Okay, so a good negotiator does balance meeting a client's needs whilst also achieving your own sales target. Okay, the next bullet point, I think over my years, is this and continuous improvement, which tends to plateau people and keep them very much at the same level. Sales is knowledge driven. There's no two ways about it. Success in sales comes from, a deep understanding of your product, whether that's understanding your company, their strategies, understanding financial markets, understanding data. It's not just about having charm or the gift of the gab. Being well informed about your product or service makes you credible and trustworthy to clients. And that's one thing you've got to be very much focused on. You've got to be staying informed, regularly study financial news and markets, stay up to date with anything that's relevant, insightful, that you believe would add value to prospects. Okay, understand trends, market conditions, and that's going to strengthen any recommendation or strategy you will have. So really break down everything, whether that's equity, CFDs, ETFs, understanding options, understand the data that's being released, understand the news reports that are coming out. As I've always said, investors are going to buy into the fact that you can add value and you can educate them, so they feel they will get something out of you. But if you don't have that same level of knowledge as an investor, you will not bring them on board as clients, or at least not the real clients that you need, the high net worths, in order to really scale yourself in this industry. Now, when it comes to relationship building, this was an element I would say I probably had struggles with early on. I was fairly good at explaining to clients how we can add value, understanding clients' needs, and then cross-selling. But when it comes to relationship building, this is what really takes you into a different level. Establishing and nurturing relationships is essential. They're more likely to buy from a person that they trust and connect with, rather than just a company or a product. And that's not just opening the account. That's also down the line, year, 2 years down the line, they could come into further money, or they may be in a position where they get on far better with you than their other broker, so they're going to shift all their assets from their other broker all the way to yourself. So relationship building is not just for the initial stage of opening the account. It is also there for the duration, where you're in a position where they may recommend colleagues or friends to you, and that's naturally how you can scale and grow your client base that bit better. The next one, I've put here is goal orientated and self motivated. Uh, Outside of the fact you will have your own KPIs with whichever firm you may go to, it's important to have your own set of short, medium term, and long term goals. One short term goal could be the fact that every week you want to have 10 solid leads or 20 solid leads per week, and at the end of the month you want to open up 5 to 10 accounts, for example. Medium term to long term, it may be studying for your regulations examination or studying for other further qualifications. It could be monetary targets that you may, each month you may want to have clients that have generated you X amount of income and commission. Okay. When it comes to being self-motivated, you're the only one in charge. Bringing on clients solely rests with yourself. Of course, you will have all the information, you will have the leads which have been paid for by the company, you would have a phone screen, you'll have everything you need. It's very easy to get distracted, and motivation can divert, especially if you're not hitting the targets as often as you would like. But it's important to stay very much self-motivated. It's a numbers game. Believe me, a situation can change on the back of one phone call. Okay. It's happened in the past and it continues to happen. The more you are persistent, the more calls you're making, you are the only one that can generate you the level of funds that you require. So always remember to be upbeat. Don't worry about the word no. And just apply each phone call with the same strategy that we are trying to implement. Okay, confidence comes in two elements. One being yourself. This industry can definitely beat you up. Any form of sales really can beat you up, not only financial sales, because we know the fact that majority of the calls will be individuals saying no, they're not interested, they don't need your service, so on and so forth. So it can be an industry which breaks you down, but you got to really pick yourself up. No is just a word. There's many different investors out there that are prepared to listen to you and take on board your advice. But then you must also believe in the value of the service you are selling. Understand what your company does. Why are they better? What are their unique selling points? Because if you have confidence in what you are selling, that will translate to having trust, or customers having trust in yourself. Okay, as mentioned, fearlessness in facing rejection is important. You need to handle rejection without letting it affect your motivation. Okay, that is one of the key aspects. So just remember, no is a word. Do not worry about it. We pick up the phone, we go again. Now, as I mentioned earlier, continuous improvement is important. There's no magic formula. There isn't a one-size-fit-all approach when it comes to being successful within sales. It does require adaptability, continuous learning, refining your strategies based on experience and feedback. Always look to the left and the right of you. Who are doing well on the phone? What are they doing different? Everyone will always have a different approach. Okay, but as I always say, it's all about the knowledge and how you're coming across. So some people are a lot more easier to get onto over the phone, and there's no two ways about it. As I mentioned, I wasn't naturally the most gifted when it comes to building rapport early on. That naturally took a bit of time, because I used to look left and right and I used to realize other people are going about it in a different manner, even though they may not have the same form of knowledge as me. But once you can build that trust, it's easier to put forward that knowledge. So always continue to improve. Look at what you're doing right, look at what you're doing wrong. Celebrate the small wins, whether that be generating a lead, whether that be arranging a meeting. Celebrate that. It's not always about generating the accounts and bringing the funds on. That will naturally happen in due course. So focus on adapting and continuing learning. And that's not only on yourself, but also within the market as a whole. Okay, we're going now into looking into the objections and rebuttals. Objections are a normal part of the sales process, and it provides insight into the client's concerns, and it'll allow you to be in a better position to address those specific needs. So no matter what phone call you are going to have, you will have objections. Either they're not interested, they don't want to do anything right now, they've got brokers, so on and so forth. Okay, it happens in sales, so there's no two ways about it. But our aim is to work on the rebuttals. Rebuttals are a tool for guiding the conversation back on track, and is really there to address the concerns with solutions, ensuring that the client feels reassured and more confident about their decision. So I will go through a lot of the more common objections and different ways around it. And as I always say, and no matter what you come back with, if a client is not interested, they are just not interested. So don't worry too much about it. Okay, we'll just move on to the next client. But when they do have an objection, it's important for us to come back with at least 1, 2, 3 points to see if we can, in essence, get them back on track. Because every client that I've ever had, believe me, not one of them have picked up the phone and said, Arj, yes, I would like to open up an account. Okay, it's always started with, I'm not interested, or I'm not looking to do anything right now. So no matter what broker's been in the city, what level they are, they would pick up a call and it would be a case of, I'm not interested. So think about all the clients that have been opened. A lot of all the brokers would have overcome that and handled it efficiently. So hopefully we're going to get you on the right track so you know how to deal with it. Okay, these are the first two objections we are going to be focusing on. The more common one will be, I am not interested. But when it comes to objections, there's a simple structure you just need to follow. Okay, one is to acknowledge and empathize with the objection, focus on a solution by way of a strategy, and provide education, real life information that is out there in order to adjust or change the objection. Okay, so always bear that in mind. The first will be acknowledge and empathize with the objection. Second, focus on a solution. And thirdly, provide education. And as we always say, no matter what you will say in certain circumstances, it's not always going to change the outcome. If someone's not interested, they're just not interested at times, no matter what you can see or read from other people out there. Now, acknowledge and clarify is one of the more important parts with I am not interested. One way of going about it is, look, I can completely understand. Can I ask what specifically doesn't interest you? Okay, what is it about what I said is not of interest? Is it the fact that you are not interested in investing in this current market climate? Do you currently have a broker? What are you just not interested in? I would love the feedback in order to just make sure whatever service or solution we have is right or wrong for you. Okay, so always go in with that. What are you not interested in? The second one would be a case of acknowledging, yes, many of my clients initially would have felt very much the same way, receiving a call and their initial response is they're not interested. It's typical, sir or ma'am, but may I ask, what is your current investment strategy? What are you looking for at the moment? Okay, another way of looking at it is, yes, a lot of my clients would have initially said they're not interested until they really realized what we actually do, how we operate, and how we build investment strategies around their current needs. Okay, so this point is more just reiterating the fact that, yes, you've got clients which are not interested initially, but once they have seen what you are capable of, they generated that interest. One could be a case of, look, I respect that it's not the right time for you right now. How about I check back with you in a couple of months? But in the meantime, I'll be keen on getting some further information out on us, as well as keeping you updated on a lot of our trade ideas, as well as our strategies and our reports. So you're always fresh in the mind with the client, and just in case the situation does change, you're in a position where you can get on board. Okay. Another way of going about it is, it's sometimes hard to see the full picture on a first call. I don't blame you, so I'm sure you receive a number of calls like this on a monthly basis, so I can understand it's difficult on a first call to really see the value. Okay, but how I believe I can go about that is either by providing further information, showing you a number of strategies and solutions we've implemented and the effects it's had on our client portfolios. Um, Another one would be just to see, what market condition are you waiting for? Because the not interested part can come at many different stages. You'll always get it on a first call. I'm not interested. But even in the second call, when you are explaining a strategy, they'll be like, you know what, I'm not interested. What are you not interested in? The strategy I put forward to you, does that not match your investment objective? Is it a case of, what market would you need to see? What market condition are you waiting for? What do I need to show you in order for you to have that confidence to invest? Okay, so there's multiple different ways about going about it. Just always empathize and understand, provide a solution, and more importantly, educate. It could be, I'm not interested in the market. It's a difficult market. And provide solutions. Well, in a difficult market, in a negative market, there are stocks that perform very well, predominantly like low beta stocks. They have a tendency to remain relatively stable, provide you with that income, and when the market does look to recover, we can shift our focus on more actively managed portfolios or ETFs. We can focus very much on purchasing higher beta stocks. So there's multiple different strategies and ways you can go about it. But try as much as you can in order to get the client very much, back on side. The next one objection we're going to go into is, I don't trust the market right now. The client, in essence, is expressing concerns about volatility or uncertainty in the financial market. So any form of rebuttal is designed to acknowledge their concern, provide some form of reassurance, and focus on how you can help manage that risk. Okay, because the markets are going to have a lot of uncertainty, and if you're new to investing or have not invested in a long time, market dynamics can influence your decisions. Okay, understand, market volatility can be upsetting. Provide data and historical market trends showing how markets recover from downturns. But the key one would be, what market condition are you waiting for? Because if we look in today's market, we have hit all-time highs. Markets have continued to rally. Markets don't seem to be shocked by anything, whether that's geopolitical events, whether that's wars. The market still remains incredibly robust. Interest rates are still coming down. So the sentiment is still very strong. So then you got a question to your prospect: what are you waiting for? We've seen all these things that can deter an investor, but clearly investors are still very much on the table and they are still very much investing. Okay, so always pose that to them. You can, I'm of the belief where I don't naturally cave into their view. Okay, they say, oh, I don't want to invest because the market is uncertain or I don't trust it. You don't want to just always say, I completely understand. I can understand how you feel uncertain at these times. You should have your own opinion. Say, look, I understand where you're coming from. That there are concerns within the marketplace that can shift the dynamics. Okay, but if we look at the fact that we've had global inflation at all-time highs, we've had high levels of interest rates, we have had wars, we have had geopolitical tensions, but still markets have gone on to hit all-time highs. Okay, second of all, we've got to bear into mind that inflation has come down to many nations' preferred level, 2-3%, depending on which region you're in, and interest rates are starting to come down. Okay, when interest rates start coming down, as we've already seen, markets and investors are that bit more in tune, and they keep very much risk on. So that's one way of looking at it. Another one is maybe looking at the long-term benefits. It can be a case of, yeah, if you do believe the markets are uncertain, markets can be unpredictable in the short term, but history does show us they tend to recover and grow in the long term. Look, markets go like this, we'll see a dip, but we'll always go up and hit all-time highs. So if you are focusing on a long-term strategy, it's important to select, solid stocks that will, cater for you in any form of negativity, as well as stocks that will benefit in the long term. And it's essential to diversify, spread your risk from equities, CFDs, and ETFs. That will align with many people's portfolios. Another one would be focusing on risk management. Focus on your approach. We focus on diversification. We focus on managing risk. We can build portfolios that include assets which are safer, like low beta stocks, ETFs in bonds. We can go into defensive stocks, okay? But we can also look at the likes of CFDs, take advantage of short-term fluctuations, but keep a very close eye on our stop losses and limit orders. Understand our entries, keep an eye on auction periods, keep a very close eye on margin. You want to provide that reassurance and education to your investor. And that's what predominantly will tend to work well in both these objections. So really just, put yourself in the mind of an investor, and then just understand the market conditions, and that will help you with the right rebuttal. But feel free to keep rewinding and going through the rebuttals I have mentioned, as that tends to work very well. Okay, now with the next set of objections, we're going to be focusing on objections regarding I already have a financial advisor or a broker, as well as I don't have enough capital to invest right now as I am fully invested. Okay, so they are both very common. But when it comes to the first one, that I already have a financial advisor and broker, there's 4 elements you want to focus on. Is first and foremost, respect their current advisor. Always acknowledge their existing relationship with respect to, not being pushy, dismissive. You don't ever want to be in a position where you say, look, we are better, your broker's bad, they're crap, so on and so forth. That never works. Okay, you want to always be in a position where, brilliant, most of our clients have more than one broker. Okay, you're not looking to change what they're currently doing if they are incredibly happy with it. Okay, you want to be in a position where you can offer value. Focus on ways in which you can add value to any prospective clients. Is it a case of, a second set of eyes having a look at the portfolio? Is it something that you do different to their current provider? Always find that way, and the way you go about it is by probing gently. Okay, probing questions, things like, how well is your broker performing? What are you currently involved in? What are you focusing predominantly on? Stocks, equities? What is your outlook on the current market condition? Where does your broker see the market going? Okay, is that broker your main broker? Do you have more than one broker? So just offer probing questions, and that usually comes in a second call sort of scenario. Okay, emphasize no obligation approach. It's naturally always going to be tough to get on board an investor if they're content elsewhere. Okay, but you always want to be in a position where you can offer them literature, research. Always keep in their mind, offer them a call every other month or once a month easily, maybe more, I would say. Make them aware. Look, have you seen the current market condition? Did you take advantage of this current rally? What were your thoughts on this takeover? Anything of that nature which you think is of relevance, always drop them a call, as it tends to be the best way to keep in the mind. And at one stage, at one point, the client or the prospect will be like, you know what, I'll be happy to come on. It seems like a great idea. Okay, so with the bullet points here, always bear in mind, it's acknowledging, most clients have more than one broker. We're not looking to replace your current broker, but we are open, but be open in ways in which we can complement and help. Okay, always highlight your unique selling points. What do you do different to your competitors, and always provide examples. So a couple of scenarios I will just reel off now, and this is how you would want to go about it. Okay, where is my slide? Okay, yes. So always acknowledge and respect. Look, it's great to hear that you've got a financial advisor. It shows that you are serious about managing your wealth. Okay, but just like with many of our clients, they found value in having more than one provider. Okay, and many of their providers would focus predominantly on equities, wealth management, retirement planning. They would come to us in order to get specialist advice based around derivatives and ETFs, ways in which they could take advantage of the short-term fluctuations in the market, benefit from any form of pullbacks, ways in which to hedge portfolios whilst really having a strong emphasis on risk management, stop losses, limit orders, managing margin is an element of our service, which is different to many other providers out there. Okay, and make them aware that even though they did take on board our service, they still engage very well with the provider that they initially had. Okay, and as mentioned, always ask question, what do you do with your broker? Is it just equity, CFDs? That's going to give you an option of cross-selling. But this one, I touched on it. Look, how has your broker performed in the last 12 months? Okay, some individuals will come back and say, what, we struggled over the last 12 months. And then the last thing you want to do is then fire back and say, oh, well, we've done this over 12 months. We've made 100% gain, so on and so forth. I found some of the best options were to say, I can sympathize with that. The market has been tricky over the last 12 months. We have seen investors not really benefit or realize the true potential in the market rally. Okay, so I can appreciate and understand how certain providers, manage the situation differently. We are not immune to the fact that the market is very difficult. We have had some clients on different strategies, similar to yourself, which haven't realized the true potential. Okay, but what we do different is, we focus on diversification. We look to spread our risk. We look to focus on different asset classes, which allows us to compensate in other areas. So these are the ways in which you want to go about it, acknowledging where things have gone wrong, but ways in which you can really benefit and add value to the prospect. Highlighting specialized services and expertise is an important one. Okay, while you're working with current advisors, we often find that clients seek out specialized expertise in certain areas. As mentioned, if a client is purely focused on wealth management, excellent, that's brilliant. Okay, a lot of that does though involve retirement planning and focusing on income, not at times not a huge emphasis on growth. So you want to highlight some of your unique selling points. What are you different in? How can you add value to what they currently got? Not replace, but add value. It's brilliant to see that you're earning X amount of money or X amount of return yearly. But if given the opportunity, we may be in a position where we can provide this sort of return based on what the market is currently doing. Okay. Focus on collaboration. I'm glad to hear that, someone is guiding you. I'd love to work alongside them. Okay. If you're very content with what they're doing, brilliant. I personally believe with what we offer, it will not hinder. You're not looking to duplicate positions. We're not looking to replicate what you currently got over there. We're looking to add something of value on our end. Okay, we work very closely with multiple brokers our clients have. Okay, so always put it in a consultative sort of approach where you're not looking to butt heads, and a lot of that is the reassurance to the investor that there is a possibility that working together could possibly work. Okay, now we're going to focus very much on, I don't have enough capital to invest right now. I am fully invested. Okay, now very commonly, again, it's sometimes it's not even an objection. Sometimes just like with our first one, it's just a way of getting people off the phone. I've already got a financial advisor. A lot of people may not have any form of comeback for that, so they just put the phone down. So investors more often than not will use these as not a true objection, but just really to get you off the phone. But again, it's still important to go about it the right sort of way. Um, you know, the main points I focus very much in is empathy, especially if they don't have a huge amount of capital. It's going to be something you come across with. Always focus on strategies and flexibility. Smaller investments can be compounded. Okay, so even give them the option of investing at a smaller scale, and then when they're more comfortable, they can up their level of investment. So have that degree of flexibility. Focus on the long term. Wherever we're looking to invest now, we're not looking necessarily to see a return today, next week, next month. Let's invest every month or every year consistently until we grow the portfolio to the scale that the client is absolutely happy with. One of the ways in which we go about it is a portfolio review. Look, I can completely understand, and it's great that you're already fully invested. Many of our clients are in a very similar position, but after reviewing their portfolio, we have found ways in which we can optimize and adjust the portfolio for better returns as well as to reduce risk. And now, whichever way you will tend to look at this, anyone that is fully invested will always have areas of their portfolio which are not performing well. That's the harsh reality of it. Okay, whatever was a good investment last year doesn't mean it's a good investment this year. A lot of people are holding positions which they bought 10 years ago and hoping it goes back to that same sort of value, and it never will. Okay, we're always in a position where we encourage clients and investors, look, sometimes it's better off realizing the loss that you've got in these areas and reinvesting whatever capital is there in areas where there is potentially further growth. Okay, it's a way for you to potentially recoup the losses that you've already experienced elsewhere. Okay, that's one thing I want you to really try doubling down on, and that's will come down to your probing questions. Look, what are you currently invested in? What is your objective? What is your strategy? How well is it going? How well have you performed over the last 12 months? Okay, by you being fully invested, does that really mean that if an opportunity or a strategy presented itself, you would not be in a liquid position to go ahead with it? Okay, and with anything within sales, it's open-ended questions. Try keeping it that way rather than the yes and the no, because it will then get you in a spiral of you speaking more than the client. Okay, so get into them, ask them how well is their portfolio doing. By you being fully invested, what does that mean? Are you invested in all the areas you want to be invested in? Okay, another way is offering a second opinion. Okay, not all clients will offer this, but I've done it many times in the past where I have asked the individual to, and it works with existing clients as well. Send me an idea or a spreadsheet of the stocks that you currently have, when you bought them, so forth. And let's see if it matches up with your overall objective. And as I said earlier in our earlier point, having a different set of eyes on a portfolio could lend a different perspective. We're not looking to replace what you're doing. I'm not looking to tell you to sell anything, but I'm happy to give my opinion. It can uncover new strategies or areas for improvement that could possibly have been overlooked. Okay, and then make them aware. Are you open for a brief discussion to explore whether there are ways to enhance your portfolio? And more often than not, clients which say yes are probably struggling. Okay, if they do say, yeah, look, I'll be open, it's probably the fact that they are struggling, and that could be down to the fact that the broker they're with is not providing them the right sort of advice, or just reading the market differently to what you may be reading it from. Okay, another way we focus on is suggest exploring, ways of diversifying. Okay, it's great to see that you're fully invested, but it's sometimes worth exploring new opportunities to diversify further, or hedge against any risks in the current market? Would you be open to discussing strategies? Okay, and if they say they are open, then you can look into their current strategy and see if there are stocks that they may be in a position to close and reinvest. Remember, you don't have to always close positions that are at a loss. There could be certain positions which are trading at a profit, but the room on the upside is potentially not there. So it may have reached a cap. So it could be a case of realizing those profits, reinvesting, or it could be a case of, instead of closing positions, scaling down positions, each of them maybe by 10%, in order to realize some capital to invest in a new diversification strategy. Ways to hedge, manage the risk. Those are ways in which you can help. You can't advise them to do it, but you can suggest ways in which they could do it. Okay, one suggestion: perhaps look at closing, stocks which are not doing well, reinvesting in good areas. One, realize profits, reinvest that capital. If you don't want to do that, scale down positions, realize capital and reinvest. Okay, another way is similar to the other one, which is, introduce new opportunities. Okay, it could be a case of the client's not fully aware of ETFs. How do we go about taking advantage of bond ETFs, commodity ETFs, currency based ETFs? These are all ways in which you can prick up the ears of an investor and make them think, what, that might not be a bad way of going about it. Okay, and yeah, that's pretty much it. I've discussed this point already, but just to recap, is really focus on undervalued areas. Fully invested portfolios naturally have underperforming assets. We're happy to review that for you. We're happy to review areas which are not doing so well for you and provide you a strategy and a solution on ways in which to recoup that capital. Okay, so always bear in mind all the points that I've mentioned, as that tends to be some of the best ways of getting around these sort of issues. Okay, so the next two objections we're going to be looking at is I've had bad experiences with previous brokers and I don't believe in paying for financial advice. These are very common objections that are on the phone on a daily, weekly basis, so it's important for us to find different ways around this. With the first one, I've had bad experiences. A lot of that is on the back of negative experiences with other brokers. If an investor's been around long enough, unfortunately they've been around to a few other brokers. A lot of the clients I had, we pinched them either from other broking arms, or they came on board with us based on the fact that the previous broker was not that great. If that's said to you over the phone, you've got to be showing a lot of empathy, show an understanding, a bit of compassion for their past experiences. Don't dismiss their concerns, because the communication and the transparency is going to be important for you. It's going to allow you to separate yourself from the bad brokers that they've had in the past, what makes you different, a lot of your unique selling points, making strategies a lot more bespoke. A lot of the brokers in the past that they would have dealt with may not have given them the best advice, so clients lost a lot of money. The service may have not been bespoke. It may have been a one-size-fit-all sort of strategy, so not really understanding risk tolerances and the objectives of an investor. It could have been based on the fees. It could have been based on lack of communication. A lot of clients like to be spoken to every day, and that's something you have to adapt to. And if they don't feel they get that personalized service, they're more likely to move on. Okay, so understand where something has gone wrong and how you can overcome it. You can look and maybe adopt, a low risk strategy for them in order to build their confidence. But overall trust is built over time. And that could be a case of, you just constantly keeping in touch with the investor, keeping them informed of information that's out, whether it's data, whether it's earnings, always keep in the front of their mind to see that you are actually different. So as I always say, there's no such thing as a three-call process. It is very much of a case in today's day and age of building the rapport, building the trust, getting them in for meetings. So yeah, a couple of the ways I would go about it, I would say, look, completely sorry to hear about any previous experiences you can have or you've had. I understand it can be very frustrating, and unfortunately, a lot of the clients that we have dealt with have come from either bad brokers or negative experiences within the past. But what tends to separate us from the crowd is we focus very much on building, bespoke portfolios, really understanding the needs and the wants of our clients, and then addressing that and matching that with the strategies and the products that we focus on. That tends to be the one real way of going about it. Make it quite generic. Look, as much as the experience hasn't been great in the past, it is the nature of this industry. At times, it happens to a lot of investors. I'd love to be in a position to show you how we are different, how we separate ourselves from the competition. Okay, it sometimes is a cliche to say, "Oh, we are the best out there." Try making it generic that, look, a lot of the industry, is like that. Okay, but how we separate ourselves, what we do slightly different, why investors get on board with us, those are the type of wording you want to use in order for investors to say, yeah, what, I'll hear you out. Okay, at our firm, we focus on transparency, regular communication, and a personalized approach. You want investors to be fully informed of what you are doing and what you are trying to achieve for them. So those tend to be the best way, even if they are still struggling. Maybe go for a portfolio review. Okay, so look, I appreciate you may be doing it by yourself, or your portfolio is still currently with another broker. I'll be keen on setting our eyes on your portfolio, just giving you, our outlook and what we believe can be done different, or what we believe is being doing well for you. So always have that sort of approach. Find different ways to, get to the client. I don't believe in paying for financial advice, or as I said earlier, we'll spin it to I don't believe in taking financial advice. As mentioned, look, a lot of the information and news is easily accessible. So many investors um, don't really need brokers, and that's the harsh reality of it. Okay, especially when when I started out in 2010, 09, 2010, it was it was different times. You didn't have a lot of social media. There wasn't a lot of news flow out there, so it was very much a case of investors would come on board, and they would rely on the information that we would put in front of them. Okay, so this is a very tricky one. Understand the client's portfolio. If they are doing it by themselves, brilliant. What's your investment objective? Okay, and what stocks do you have in your portfolio that are matching that objective? So even though they may be doing it by themselves, they may not be doing it right. Okay, and with the wave of information out there, everyone says completely different things. Everyone tends to be the best at what they do, but not everyone is profitable. Okay, so what is the benefits of advice? And make them aware. Look, we focus very much on a tailored, personalized approach. Okay, expert knowledge and experience is something that's beneficial, helpful, time saving. A lot of the individuals that do invest, do trade, are actually working. Okay, so where do they have the time and energy to keep an eye on the markets, understand entries and exits? A lot of time and a lot of opportunities can be missed. Okay, so that's the benefit of having a broker on the other end of the phone. Emotional discipline, for me, I think, is one of the best points. As anyone that's traded in the past, you know how different it is from trading a live account to a demo account. Okay, so a live account, in essence, is, if you make a mistake, you're going to lose a lot of money. So emotions play a big part in that, and that can also hinder your decision making. Okay, but whilst if it's with a broker who's a neutral, it's not their capital, they're making more informed decisions based on not only the research and the reports that are coming from the analyst team, You know, they're looking at your overall perspective. So it helps removing that emotional element from an investor. Ongoing monitoring and adjustment. Look, a lot of us are in the office, very early prior to market open, and we're always keeping an eye on clients' portfolios, making sure trades are not close to stop losses or close to limits, and if they need to be adjusted, we adjust them. Okay, and at times, if you're doing it by yourself, it's not always the case. But with this one, it is always a tricky one, especially if they are, trading or investing by themselves and they are actually doing very well. It's going to be very difficult to convince them to come on board with yourself for advice. I would then go to the alternate way and just really understand what sort of fees they are paying. See if you can get them on board as an execution only client, where you allow them to do exactly what they are doing at the moment, but maybe try matching the fees or offering better fees for them so they can get in and out of their positions a lot sooner. And it may add value to them knowing that, so, come on board, we're happy to match the fees, match the rates that you're currently on, if not slightly, beat them slightly more if you can, and then say, look, on the flip side of that, you've always got an open ear if you want to throw one or two ideas around, and we'll give you our input on that as well. So there's multiple different ways of going about it, but if you follow that sort of structure, that's one of the best ways of getting back in the conversation and following on to the end goal of closing the client. Okay, we're going to be focusing on another two questions, or objections, should we say. The economy is too uncertain right now, and I want to do more research before deciding. Both very common on the phones these days, so let's see how we can go about it. Now, when the investor says the economy is too uncertain right now, naturally that does allude to the fact that they're concerned about the market volatility, potential risks, and more importantly, it's a timing element. So with this sort of questions, it's important to really have facts and figures in front of you. I always ask a client, look, how are the markets treating you? That's naturally an open-ended question. Is it doing good for you? Is it doing bad for you? What market condition would you like to see, before you start investing again? Okay, what do you need to see from myself before you look to enter the market? So I always go in with a lot of facts and figures. If we look at 2024, uncertainty is always going to be in the market, no matter what type of investor you are. Uncertainty is part and parcel of a market. But one thing we got to bear in mind is, since the pandemic lows, the FTSE 100 has been up over 60%. S&P over in the US has been up over 100%. So the markets have gone up incredibly well. Ask the client, look, have you been part of that rally? Okay, fine if they haven't. Okay, but this year alone, for example, the FTSE 100 is up 8%. Strong performances within financials, healthcare, and mining and energy stocks. Have you been part of that? Okay, you got the likes of Rolls-Royce, which are up over 40% due to defense spending budgets are going up. Okay, mining sector's done well, financials have rebounded. So those are the standard facts and figures. So what market condition are you waiting for? We've already seen great movements in this market. A lot of it could be down to the fact that you are not being guided to the right sort of investment strategies and the right sort of stocks in order for you to invest with. I'll be very keen on assessing your current investment portfolio. See the areas which are doing well and the areas that are not doing so well. I'll be happy to give you my opinion on that. Okay, so when they say the economy is too uncertain, the fact of the matter is they're probably not doing very well. They're not positioned in the right sort of place. So it's important to reel off a lot of facts and figures, use a lot of the data, and look for projections moving forward. Inflation has come down massively. Okay, interest rates are stable, if not potentially coming down in the coming months. Okay, end of year we always tend to have a very strong rally in the market. So these are the opportunities, sir or ma'am, you want to be involved in the markets and looking to take advantage of any sort of rally. And let's say hypothetically the market is to come down, that's absolutely fine. Never shy away from the fact that, oh, the market's going to collapse. Absolutely fine. You know, you want to be in a position where you are taking advantage of a market pullback. We use the likes of CFDs to hedge investment portfolios, take advantage of falling markets. And when the markets look to recover, we then buy back, whether that's purchasing new stock, whether that be averaging into existing positions. So present them with all the ideas. Never, cave into the fact, oh, this market's going to collapse. Ask them, look, what's your reasoning for that? Why do you believe the market is uncertain? Why do you think the market will collapse? Allow them to provide their own data and their own information and their own justification for that. And in turn, you will have to reply back with strong facts and figures. Use history, as your ammo. Okay, so if they believe the market's going to collapse, I say, look, that's an interesting point of view. But, judging by what we've seen this year alone, the markets are up over 8%. We have seen inflation down to its lowest level in 3 years. We are starting to see, central banks globally reduce interest rates. In light of the fact that we are seeing, conflict in the Middle East or geopolitical tension, investment appetite tends to still be very good. So we've got a raft of a lot of negative stuff out there, but investors are still investing. Okay, so use all that. That's not to say that's bulletproof and the market will continue to go up. Of course, there can be, significant pullbacks, but then you've got to ask yourself, what is going to be that significant pullback? Could it be the US elections? Okay, could a new Trump administration rock financial markets? If it's going to rock the US, it's going to rock the world globally. Okay, so these are you try finding important points where you can maybe find a pullback, and if there is a pullback, absolutely fine. We will look way ahead of time. We will look to hedge portfolios. We'll take out CFD index shorts. We can look to short even a passive S&P ETF. Absolutely fine. Okay, so those are the ways of going about that sort of question or objection. Okay, and the next one, I want to do more research before deciding. Now, I would hate for that question to arise if I've spent the best part of 2 or 3 calls actually explaining the pitch. Really, this question shouldn't come about if you've explained to your client what you do, how you do it, and how it can add value to them. This really shouldn't come up. If it does come up, it's just a case of not necessarily time wasting. It's just a case of they are still very uncertain, so they may need more time. I would definitely push for a meeting where you can get them face to face and really explain all the questions they have. But I would always go back into reassuring they don't have to make a snap decision, but what is it I have missed? What do you need more help on? What are the areas of concern, or actually don't use the word concern, what are the areas of uncertainty? Okay, what areas of the strategy or ourselves would you like more information on? I'm happy to provide that to you right now, whether it's over the phone or we can get further literature over to you. But it'll be important for us to really understand what more you would need to see in order for you to make an educated decision. Okay, and that's all that we're looking to do. Okay, so I would go about it that way. Have some form of urgency about it. Okay, so look, man, based on the current market condition, based on the strategy we have in front of you, this is something we would be keen on moving forward and actioning for you right now. When are you likely to decide on if this is right for you? Okay, I'm quite keen on perhaps discussing this early part of next week again. Happy for you to come down into our offices so we can break it down further. Okay, so always use literature as well if you can. That always tends to be decent information if they require it. But if they say, I want to do more research, remember, what do you need more research on? Maybe I can address that for you right now. Okay, I'd rather address it now, so when you do go away and have a think, you have all the information in front of you in order to make an educated decision. Okay, so as I always mention, if we did our job properly and we explained everything thoroughly, this one shouldn't come about. But if it does, try finding out what areas are of concern to them, provide them with all the information that when they go away, they can make an educated decision, and when they come back to you, it's either yay or nay. Okay, and if it's not, oh, I don't want to do anything right now, don't have the time, markets are uncertain, remember, then go back to the other ways we handle the other objections. But all in all, these tend to be, across all the slides, the most common form of objection you will have. You will notice, with the way I answer a lot of the questions, the structures remain very much the same. Okay, it's just really about understanding what sort of objection it is, just being calm and composed about it, whether you need to be showing a lot of empathy and concern due to their own decisions or their current situations. That's important. Always look to provide a solution. Never try making anyone look bad, whether they be brokers or companies. It's never a good look. And using the data and the research to back up all your ideas. That's the only way it's going to help. Investors need to visualize what you are telling them. Okay, if the market has a pullback, we can use CFD shorts. We can look to buy back in once the market looks steady and looking to recover. We can average into positions. We can do CFD longs if we want. Okay, put them on the spot. Oh yeah, I'm not sure about the market. What are you not unsure of? What do you need to see? What do I need to show you before you look to get involved? Okay, markets have rallied incredibly this year alone, let alone over the last 4 years. Have you been part of that rally? If not, why not? What market condition then are you looking for? Because we've seen all of them over the last 4 years and you have not been a part of it. Okay, a lot of that will then, sir or ma'am, come down to the fact that you are not being guided right. You're not being presented with the right sort of information in order for you to make an educated decision. Unlike ourselves, we dedicate on providing research, personalized approach to all our investors. We're fully in tune with the market, fully updated, and that's what you want to do. We look to take advantage of these movements in the market. We look at the likes of Rolls-Royce. We look at the global situation. We understand there's a huge amount of defense spending which is going to be increased. Rolls-Royce is not just a car manufacturer, they're aviation based. So understand why they've done well. Why have energy companies done well? Well, of course, with the cost of living crisis, energy prices going up, they naturally do well. Pharmaceuticals have done very well. So understand the sectors do well, and then once they can visualize it, they're better in a position. And if they want to do more research, absolutely fine, but let me provide you with further information so you can go away and be better prepared to make a decision.